All right. Well, good morning and happy Tuesday. Welcome to our Simply Tax Talks for today, February 22nd, I guess, 22222, if you will, in terms of the day here. I'm excited today for two reasons. One, I want to share a great announcement. If you've been following and joining our Simply Tax Talks, Yelena is actually not able to join us today for a very good reason. She welcomed, and her husband, I should add, welcomed Levi, their son, last week. So she is at home spending time with her growing family. So congratulations to both Yelena and Daniel for the new addition to their family. But secondarily, I'm excited because we have another guest here. In addition to Tad, who's here as he often is, to give us his take. We have Travis Truesdell as well, joining us live this morning from Kansas City to share some insights on the real estate industry. So welcome to Simply Tax Talks, Travis.
Thank you. Glad to be here with Damien and Tad, two of the BKD Tax Mount Rushmore heads, as I like to call it, on no less the day after President's Day. So honored to be here, guys.
Nice time.
Block ends, is that what you're saying, Travis?
Something like that. Nah.
Well, thanks, Travis. We appreciate you being here. So, and maybe with that, let's get into our top tax topics of today with Travis. All right, so Travis, I guess I didn't give too much of the background here, so maybe just a little bit of the who you are and your vantage point, and then kind of what you're seeing. I think that's the biggest question. I know I often get this time of year, and very curious, particularly from your lens, what you're seeing. So who are you and what are you seeing?
Excellent. Yeah, so Travis Truesdell, and I'm a partner in the Kansas City office here. I've been with the firm, I think this is my 14th or 15th tax year. I lose track already, honestly. So been in Kansas City virtually my whole life, except for my college career. And really, as I like to tell my clients, I like to tell them I grew up in the real estate industry to a certain degree. My stepfather owned, 20 some rental real estate properties growing up. And every weekend I spent with him replacing a refrigerator or patching a roof. So I like to think that I kind of grew up in the industry to a certain degree. So that's kind of dovetailed well into my career here at BKD, being I help head up our construction and real estate tax practice here in the Kansas City office. And my primary focus is typically with real estate clients, developers, commercial real estate, brokerage companies, so on and so forth. So I get a lot of great interaction with those folks. They're typically, really great people, deal guys, as I like to say, primarily. And so, so then it's like, what is the number one question I get from them? And it's almost like, what are they seeing in the market is one angle to go down. The other angle is, what about from a tax perspective? So one of the things I hear a lot is kind of, where did all the good deals go? There's a lot of capital in the markets right now. Everybody seems to be, want to become a real estate guy and want to be swallowing up a lot of these great opportunities in the marketplace here. And really, it's a great time to be a seller. Don't get me wrong. There's a lot of great properties out there to go buy. And the property that you bought even a year or two ago is probably appreciated in value significantly. So it's a great time to sell. But then what happens after that? So there's a lot of then discussions about, okay, what are the opportunities to do 1031 exchanges? But typically getting those replacement properties seem to be harder and harder to find, because when investors look at those, they don't see that same value that they saw when they sold their property. It's pretty typical to those if anybody in the audience has recently gone to buy a new home, and yeah, it's a great time to sell your home, but going to find that new home is always a little bit of a challenge, right? So that's the number one thing I typically hear. From the tax rate perspective, everybody wants to say, okay, well, I heard tax rates might be going up. Is that happening? If not, when is that going to happen? So there's a lot of good discussion about that. Especially on that always goes into the politics side of things, which is fun. Again, that's why it's always great to have a team like Damien and Tad here in our national office to kind of help steer us in the proper directions there. And another major concern I get a lot too is, are they going to get rid of 1031 exchanges? That's something that is near and dear to the hearts of so many of our real estate investors and clients that they get really concerned about that. So I know you asked for one question, Damien, but I like to always go above and beyond. So I gave you a couple that I've been hearing.
No, those are great. I appreciate that. And I'll tell you, as a guy that's looking for a place, my wife and I have been looking for a home here, and it's tough being on the buying side. I will definitely tell you. So I'll echo that just from my own personal vantage point. From having two kids and needing more space, kind of thing. The typical. But yeah, I guess with the planning in mind. I mean, are there areas that, like you said, there's a lot of questions about what happens with tax rates, and as we've kind of talked about on here, my crystal ball is maybe as good as yours, maybe not as good as Tad's. Tad, I think, has a pretty good crystal ball, perhaps. But what planning things are in the conversation, or are you talking about these days?
Yeah, so I would say it kind of depends, and let me expand on that a little bit further. It really depends on where the investor is kind of in his overall career life cycle, if you will. I've got some clients who are kind of a little bit more advanced in their careers, is one way to put it. And so some of those folks are saying, hey, I can see what's on the horizon coming up at some point here. There's going to become a day of reckoning where tax rates will spike, perhaps. And so a lot of those folks are saying, hey, I'm going to take, the rates haven't gone up yet. I'm going to take advantage of that. I'm going to cash out if I get a good offer that comes along, take the hit from a tax perspective and then kind of move on to greener pastures type deal. For those who are a little bit more in the earlier stages of their career in the real estate industry, a lot of those folks have been looking towards, okay, if I'm going to sell, I'm going to be looking into another exchange potential. And so what are the opportunities there? What are some ways to kind of alleviate tax burdens related to that too? Usually what we're looking at primarily is cost segregation studies are a fantastic way to kind of go alleviate some tax burden on properties that you're acquiring. And so those could happen in conjunction with the 1031 exchange as well, where you're trading into a larger, bigger property, higher value. And then, then you're able to come in and bifurcate that property down with an engineering-based study, which is the cost segregation study, to help accelerate depreciation. And the 100% bonus depreciation rules are still in effect. So this is kind of a good chance to maximize the depreciation on some of the shorter-lived components of your new buildings you're buying. Works really well with office, retail, industrial does pretty well on that also. And also when we talk about, other segments of the industry, multifamily is one that I've seen a ton of activity in lately. Kind of to Damien's point, everybody, kind of has that starter mentality to a certain degree before they move on to that, hey, I need that more space. But really there's so much activity in the multifamily space. And with our clients as well, we're able to kind of find some more ways to help them put dollars back in their pocket. One of the opportunities there is called the Section 45L credits, which have to do with energy efficiency of new multifamily construction. There are some limitations to the size of the structures, but it provides a developer, a builder of those, with a credit of $2,000 per unit if it's able to meet some of these certification standards. So just another way to kind of continue to bring some great ideas to our client base and help them alleviate any tax burdens that they have, from the LLC down to the individuals.
Absolutely. Yeah. And we actually got a great question here from the audience, and maybe just a reminder too, to, get your questions in. That's what we're here for. We love to answer your questions in real time. But Doug was asking kind of around the holding period and how long you would maybe hold a property before you get that cost segregation study done.
Yeah. So that's a great question. I guess as far as the holding period, you could do it at any point in your, ownership of the property. And the benefits there is you would kind of get the study performed and look back and kind of recalculate your depreciation over the previous years. But it would still provide a benefit. So you can kind of use that to your advantage. For example, if you see that rates are going to be going up next year, maybe you hold off on doing a cost segregation study until rates are higher to get a little bit more bang for your buck as far as the accelerated depreciation goes. As far as like the number of properties that you should own also, I mean, I've got clients who, they bought one, office building, industrial building for a couple $1,000,000. They do a cost seg on that, get some tax depreciation benefits. So then that clearly reduces your tax basis when you sell it, but then you exchange into the next property and you continue to kind of build on that. Now, eventually you're going to start hitting some peaks in the market where the values kind of continue to increase, but there's still some opportunities there with some kind of unique tenant in common structures and so on and so forth to kind of help taxpayers in that regard as well.
Yeah. So, I mean, again, that's not new to the game, right? 1031 exchanges and so forth. But are you finding that maybe it's as much interest in continuing to do that, like you said, and build that? Or there, this is maybe going back to last year. Obviously, there were some concerns about the rates, maybe a little bit more concretely going up at that point in time. So how has that been impacting the conversations and the planning maybe around 1031 exchanges with those that you're talking to?
Yeah. So again, I think it's one of those that kind of depends. We under the CARES Act that passed kind of when COVID hit. So I'm thinking, back 2 years ago, the IRS provided, in my opinion, real estate developers with a fantastic tool to generate losses and be able to carry those losses back to previously filed tax years. What that was able to do was to kind of help taxpayers recoup dollars that they paid back in 2015, 2016 tax years. And if they were able to basically do a whole bunch of cost segregation, to put it pretty simply, to generate a whole bunch of tax deductions, to generate a loss on their 2019 and 2020 tax returns, they were able to carry that loss back to previous years and do an NOL carryback to get some refunds. That ship has sailed to a certain degree. So in 2021, we can no longer carry those losses back. That doesn't mean that this isn't still an attractive opportunity for certain investors who may have other gains going on in their real estate portfolio and be able to, use the cost segregation to help offset a lot of that activity in their own personal portfolio that may be triggering gains to offset that. So then you kind of have a little bit of a balancing act between, okay, I've got, $2 million of income to offset, and I've got a $8 million building that maybe I can get $2 million of cost seg on. So you want to just kind of time those correctly to hit it all in the same tax year is my suggestion there.
Great. Yeah. And it's interesting. I was actually just having a conversation with somebody about that last week, and maybe it's almost like you have different levers you can kind of pull there and kind of making sure you're balancing things out, obviously. But, another one that's come up quite a bit, and I guess as we're talking about maybe the opportunity to defer, the payment of tax on a gain and so forth, and even additional benefits is qualified opportunity zones. What's been going on there? What's the interest been? I mean, obviously we're several years now into it, but is that still something that you're hearing a lot of questions and maybe deals and conversations around?
Yeah, there's still certainly quite a bit of it that I'm hearing, at least. I will say that overall, because this was part of the TICJA, the Tax Cuts and Jobs Act, created the Opportunity Zone program, really, in my opinion, a very revolutionary tax concept, and allowed real estate investors another lever to pull, using Damien's analogy here. But, I would say overall the appetite for opportunity zones was far less than what was anticipated when those rules came out. And not to say that it's a bad thing by any means, but it just didn't end up working back in the favor of a lot of real estate developers to the extent that, many were hoping it would. But still a lot of opportunities there. And, I would say in Q3 and Q4 of 2021, we certainly saw an uptick of deals closing and opportunity zone funds being created. A lot of that was due to the fact that because of the opportunity zone rules, if taxpayers were to roll a gain into an opportunity zone fund prior to the end of 2021, that provided them with a 5-year, they would hit the 5-year hurdle mark in order to get a 10% haircut on their capital gains tax that they would owe with the 2026 tax year. So again, that's kind of what, so we lose that opportunity now that we're in 2022 to roll those gains. But what you're losing out on is that 10% haircut, which is, it's a nice little component to the opportunity zone rules, but it's not in my opinion, the major benefit of doing these. The major benefit really had to do with the 10-year hold inside of the Opportunity Zone Fund to get a step up in basis, which the net result is tax-free appreciation on a 10-year hold inside the Opportunity Zone. That's still alive and well. And again, that to me is the major benefit of doing these deals to begin with. So you still get the deferral, you still get the 10-year hold inside the fund for tax-free appreciation upon sale. But again, you lose a little bit from that haircut that was 15% at one point, 10% if it was in there for a 5-year period. So it had to be by 2021. So the benefit is not quite what it was a few years ago, but it's still something that in the right structure, in the right scenario, could definitely result in some very positive tax treatment.
Absolutely. Yeah.
Yeah,
I guess. Go ahead, Dad. Sorry.
Travis, one of the things with that is even though the benefit might be a little bit less on those opportunity zones, with the rising interest rate environment, it still can be cheap capital, for the project. So, I mean, maybe from the developer standpoint, it's something they still need to look at. Plus, it's usually relatively quiet money out there. It's not where you're gonna have a lot of the people taking a look at your project and things. So something to keep in mind. One thing I wanted to ask earlier, Travis, when you're going through the 1031s, I'm seeing a lot more, or I have some clients a lot more doing the tick structures because the deals that are out there they're not as many and they're usually bigger. And so we're seeing a lot of people coming out of 1031s that want to go into one project, but they're having to do it through ticks because we can't do it through partnerships. Are you seeing more and more of that as well?
Definitely. Yeah, 100%. That has been like the last 6 months really in working with clients, and they're looking for good exchange properties. As I said, it's a great time to be a seller, not really on the buy side. So when you need to get into, you've got maybe 4 million that you need to put into a new deal. It's tough to go find a $4 million building that you think is a good value and a good replacement property. So as Tad said, what I'm seeing more of then is that they'll take that 4 million and roll it into a, $25-30 million, called a medical office building or an Amazon warehouse type facility. And so now they're taking those gain dollars and rolling them into a tick structure to where they'll still get the maximum tax benefit of that, but now they're not being a direct owner of that building, just owning it as a tenant in common. So yeah, that's 100% what I'm seeing as well, Tad.
Yeah, and those things have a lot more, I guess, administrative structure to them. Number one, as far as structuring the things going in, because you got to be a little careful. But secondly, what I found is that there are a couple of more layers of fees involved with these things because you got somebody running it. And so in essence, you are in a lot of respects, a passive partner. I mean, we've got one that they're rolling into 2 large apartment projects in Kansas City. There's probably going to be 4 different people. It's, our guys have 10 million to roll, and this is like a $60 million project. So, and debt even compounds it even more when you have a tick structure out there. So a lot more complexity. Just need to get in front of clients, if they're looking at doing something like that, but certainly is an option and more one that we're seeing. So.
Yep. Yeah. Again, and the thing is too, when you get 4 tenant in common groups that are now partners in this thing, these are all real estate guys.
Partners, that's a bad word, Travis. Partner is a bad word. So.
Yeah, exactly. So everybody's got their own opinion of how it should be run, and it does take a little bit of education almost to say, hey, we're all in this together. Sometimes you're going to have to take a back seat on things. Sometimes we're going to have to agree upon things that you may not like. So. There's a little bit of that soft skill component to these deals too, to a certain degree.
Yeah,
that's interesting. Yeah. Well, you mentioned like the challenge with the deals too, and maybe I guess on the QOZ space, and again, like you said, the benefit's still a great one, the long term one, right? Are you seeing much? I guess what's the deal space looking like from a QOZ perspective?
Yeah, so usually I guess what I'm seeing more of is multifamily type deals, which is kind of, at least the way I kind of envisioned when the rules came out, the big to do about them. In other words, providing good housing options inside of an opportunity zone district, which again generally speaking, or historically, was a lower income census tract. So there's been a lot of things there, and a lot of it has been either, complete tear down and build back up type of a renovation, as opposed to more of a upgrade, or give it a facelift type scenario. So I've seen that pretty common. I've also seen some kind of strategic opportunity plays, is what I'll call it. When you already have a business location maybe inside of an opportunity zone. So I had a lot of clients say, well, I own a building, it's in an opportunity zone, what's in it for me? The quick answer was, well, there's really not much that's in it for you at this point. Just because you own a building that's already in an opportunity zone, it's more attractive to buyers, but you probably don't want to sell it. So instead, though, maybe, if you have gains from other sources, whatever those might be, there's the building next door that you've always had your eye on, and now that becomes even more attractive to you if you have the ability to use the opportunity zone rules to your advantage and kind of, expand the space, or, use that building next door for whatever the next business purpose is for your service line. So a lot of good things there.
Absolutely, there are. Yeah. So no, this is great. And again, I just want to encourage the audience. If you got questions, you get them in the chat now. But we've got Travis's contact info in the like I said, say the show notes, but basically in the description to this session here. You can reach out to him, of course, as well. And I know just from my interactions with you, Travis, that you're always happy to help and lend your expertise and your insights. So very much appreciated. So maybe what we'll do is let's kind of switch over and get Tad's take here before we wrap up for today. And maybe I'll give us a little commercial here too, right, Tad? Later this week and early next week, you're taking part in a firm webinar that we're doing on kind of 3 areas to focus on. And of course, tax. We're all a little biased here as tax guys, the 3 of us. But tax is on that list. So, feel free to sign up if you haven't already. It's Thursday afternoon, the 24th of February, and Monday afternoon, the 28th. If it's not too late to sign up, and we'll get a link out to you on that one. But Tad, what's on your mind here for this week?
Well, kind of been saving up. I was not around last week when we had the webinar here, but a couple things have happened, and probably the most, I guess, welcome from the our preparator staff was the revisions to K2 and K3 for pass-through entities. If you remember, this is the foreign reporting that has caused a lot of angst and consternation and I guess vitriol from the CPA community, and actually the IRS listened. Last week, I think around Tuesday or Wednesday, they updated their FAQs on that, and one FAQ in particular, number 15, pretty much exempted the bulk of the partnerships that we deal with and S corps that we deal with, or a lot of them. The ones where people were most complaining about is that, look, this has nothing to do with my client. My client has no reporting, but yet I still got to spend 2 hours going through this K2 and K3. Well, the FAQ 15, and there are some restrictions on it, about when you don't have to file, but generally speaking, is pretty good news. Now, I still got a bit of a disagreement with our leader, Jesse Palmer. We had a little bet there. I told him that they would come in and revoke the K2 and K3. He said no, and now he's kind of trying to back out and saying they didn't really revoke it. So I'm not sure if I'm going to win my bet from him or not. So I was thinking about putting a poll up here to see who actually did win the bet, whether I did or not. But that's been kind of going back and forth a little bit. So I think he's kind of welching a little bit on the bet here. So, but that was the biggest news, I think. From a compliance standpoint.
Big news for sure, because there's just been so much of that, and we'd had Sarah on 2 weeks ago to talk about that, the requirement and what's there, and she had that great article. But it's definitely been a hot topic of conversation at the very least, right?
Well,
Right.
it hasn't gone away, entirely.
Yeah. Oh, for sure.
We still have it. So it's just what this really did is it took those run-of-the-mill real estate partnerships where you have no issues with this, and it just takes those off the table. So there's a little bit of judgment involved. Kind of like, if you know something, you kind of have to put it on the table and file the K2 and K3. But I think, it did give us a lot more flexibility and was really, really welcome news.
Certainly was. Yeah. There was another thing that was in the headlines I saw at least somewhat last week, and I know it's one we've talked frequently about, and that's the employee retention credit.
Yep.
What did we see there?
Actually, it's it kind of surprised me a little bit. If you remember back in December, we talked about the House had put a proposal for extending the retention credit to the fourth quarter of 2021. Remember, the Infrastructure Act terminated, the retention credit, for all intents and purposes at the end of the third quarter. You had startup businesses that were still eligible in Q4, but the House, put forth somebody introduced a bill there for extending the credit, no real other changes, it's extending it to the fourth quarter. Well, here last week, 5 bipartisan senators, introduced the exact same bill into the Senate. And, according to Travis, Lucas, our, kind of lobbyist we have back there, is that it's got the support of like 54 senators already, bipartisan group. So this thing may get some traction and get some legs, for the fourth quarter. So now again, I think from a practical standpoint, it's going to be a revenue reduction qualification, unless, you happen to buy into, a couple of pop-up firms out there who think everybody in the world is eligible under a government mandate shutdown. So, but again, if you got the revenue reduction, now remember, if you had the revenue reduction in the third quarter, you would automatically qualify in the fourth quarter under the look back provision. So this is a big deal. And for you folks out there who have actually seen some of the numbers that your clients are getting the refunds on the retention credits, they are huge. I know he's probably listening here. He's back in Chicago somewhere. A client of the Indianapolis office, was all intent on getting the fourth quarter, and they yanked it out from underneath him. So there may be some life there for him. So hopefully so. But we'll be watching that one because I think that one has some real traction to get through.
Yeah, no, it'll be interesting to see for sure. So here's my question that I usually lead off with and ask Yelena, but I'll ask you. I mean, kind of what is the latest in Washington? Because it obviously kind of ties into your to this ERC reinstatement bill here.
Actually, it's funny you mentioned that. It's part of what the conversations that I'm going to be having with the webinar on Thursday on the future focus. I've got a call with Travis this afternoon, Lucas, to just kind of, he's got such great information, and intel about what's going on back there. So, obviously I'd be able to answer a lot better after the phone call, but for right now, I really don't think, you've got the rumbling and the stumblings out there, you still hear people, bandying about the BBB thing, but that thing is dead. You might cherry pick a provision or two out of it, but I just think that one's dead. So right now, there's not a whole lot that's going on. They did pass the continuing resolution, so at least the government will keep functioning through till March 11th. So
yeah, and that'll certainly be here before we know it, right? So
right.
Yeah, well, let's kind of wrap things out with our top takeaways from today. And, Travis, I know it's your first time here on Simply Tax Talks. We usually kind of do our roundabout question at the end and get everyone's take on, where we were going. Initially, we started with the BBB, but as you just kind of heard Tad say, right? I mean, hey, Senator Manchin is the one that said it was dead, effectively, right? But maybe we'll take the question to say, what do we think the likelihood is that we'll see really any of these, tax changes enacted, we'll say before the election later this year, because oftentimes tax legislation is not something you see enacted in an election year. So I guess maybe Travis, I'll go to you first. What do you think? Obviously, again, looking into your crystal ball here.
Yeah, my crystal ball is, I'm usually pretty optimistic, but on this topic, I'm a little bit more on the pessimistic side of anything really of substance getting passed through between now and the election year. As you put it, Damien, it's really tough for those who are up for election to be campaigning and putting their necks on the line for something like this. Where if it doesn't go their way, that may cost them, their election. So my gut seems to tell me I don't think anything of substance will pass related to this. There might be a provision or two that squirts through somehow, but yeah, I'm pretty pessimistic at this point. Okay,
fair enough. Tad, what do you think?
I'm unchanged. Nothing. In my view, I don't think anything will happen. Now, we did see this morning and actually last week as well that kind of the reverse. We've got some Democrats out there trying to get rid of the federal gas tax. That's on. It's like 19-20 cents a gallon. They're trying to put a moratorium or suspension on that. Republicans are not wanting to do that, and the Democrats are wanting to do it, just for the election reasons, to say that they're, trying to give something back to the people prior to the elections, which is the reason the Republicans don't want to do it. They want the inflation bug, to be a headwind, to the Democrats in elections. So that's something to keep an eye on. I'm not sure that's going to make a whole lot of difference anyway, one way or another. But I'm with Travis. I just don't think anything's going to happen of any substance here.
All right. Well, there you have it. I guess Tad remained unchanged. Questionable whether or not you won your bet with Jesse, but we'll leave that off the side. I'm going to go back to Travis. Your advice about kind of staying politically neutral, and I'm going to abstain from weighing in on that bet.
Jesse has more stripes on his shoulder than I do, so it might be a good one to back him on that one. So.
Fair enough. But Travis, thank you for joining us. I took a lot away from your comments there in a conversation. I appreciate it. We'll definitely be checking back with you here as things continue. But thanks for joining us, Tad. As always, we appreciate your takes on everything. So thank you both.
Okay, have a good week.
Yep. All right. And I guess before we wrap up here, I just want to invite you again. We got the link to that Future Focus webinar. If you want to hear the outcome of Tad's phone call with Travis Lucas, tune in, join us Thursday afternoon, Monday afternoon as well. Actually, I'll be part of the presentation as well, kind of help and facilitate a little bit. So we hope you'll see you there. But until next time, have a great day, and we'll talk to you all soon.